So moving on to the next example, same scenario for the most part. We have the lessor Connor, the lessee Vaden, estimated useful life of equipment 4 years, non-cancelable. All of that remains the same. There are only two changes that I'm making in this scenario. One is that there is a residual value. At the end of the 4-year lease term, it is assumed that the piece of equipment will have a value of $5,000, and that will be guaranteed by Vaden Company. So what that basically means is that at the end of the 4 years, they will guarantee that the value that Connor receives back is $5,000, which means if the equipment is worth that, that's all is fine and good. If it isn't, Vaden would have to make up the difference. Now, note what the result of that is. One result is that the lease payments are less because we're not assuming that the entire value of the asset is going to be used up. There will be value left at the end. Now, we still classify as a finance lease because the term of the lease and present value, etc. But the accounting's going to change. So let's walk through this. First of all, let's look at the present value of lease payments. For purposes of classification, our calculation of present value of minimum lease payments does not change, which means that the present value of minimum lease payments will include the annual payments of $15,010 plus the guaranteed residual value of $5,000 at the end. So we still meet the test requirements because present value of minimum lease payments is equal to or in excess of 90% of the fair value. So that is the calculation for purposes of classification. However, when we calculate the present value for purposes of recording the liability, we're going to exclude the residual value. Now, notice what I've got up here. I have indicated the guaranteed residual value is $5,000. There's another pertinent piece of information, and that is what is the expected value? In other words, do we believe as lessee that we will indeed not have to pay anything? So in this scenario, we're going to assume that we anticipate that the value of the asset will maintain itself and that it will be worth what we are guaranteeing. What that means is that when we calculate our liability, we're going to exclude that residual value. So the present value for purposes of recording the liability is only going to be the present value of the lease payments of $15,010. The assumption being we're not going to have to pay the $5,000, we're just going to relinquish the piece of equipment. Okay, so that means on January 1 of 2020, Vaden Company, the lessee, will debit the right of use asset and credit lease liability, but only for $55,886. Again, that is the present value of the payments, not the residual value. On that same date, just like in the previous example, we will make our first payment, which is the $15,010. We will debit lease liability and credit cash. Again, interest doesn't play into it because the payment is being made on the beginning of the year. In essence, our entries for the main term of the lease will remain the same as they were in the first example. The balances will be a little different, and I have another amortization table right in the next file our next spreadsheet. So notice in this one, we start out with the lease liability of $55,886, the annual lease payments of $15,010. Our interest is still going to be based on 5%, but the dollar amounts, of course, will change because the liability is different and the annual lease payments are different. Journal entries, on the other hand, pretty much the same. Debit interest expense, credit interest payable. Amortization expense is still going to be recorded. The calculation will be the same, but note that the dollar amount is different because we're recording the asset at a different value than we did in the previous example. January 1 of 2021, we make our next interest lease payment. And so we will debit interest payable for the amount that we accrued on December 31st, debit lease liability for the difference, coming straight from our amortization table, and then credit cash for the sum of those. 12/31/21, same thing. Our interest has changed though because our lease liability has decreased. Our amortization expense remains the same. January 1, 2022, we will debit interest payable, debit lease liability, credit cash. 12/31/22, again, we will record our interest expense, record our amortization expense. January 1, 2023, debit interest payable, debit lease liability, credit cash. And then lastly, 12/31/2023, we will debit the amortization expense for the last year's worth of amortization. By now, the right of use asset is off the books. The lease liability is off the books. We will physically return the piece of equipment to Connor, and we're through. Now let's look at the lessor's journal entries. Connor Company, the opening entry at the inception of the lease is exactly the same as it was under the previous example. We will debit lease receivable for the present value of the minimum lease payments and sales, credit sales, and then debit cost of goods sold and credit inventory for the cost. Nothing new there. We will then record our first receipt, which it will be the $15,010, debiting cash, crediting lease receivable. And then at the end of the year, 12/31/2020, we will debit interest receivable and interest revenue. Again, that will come from our amortization table. Now, note the difference in the amortization table. The receivable for the lessor is going to be the full $60,000 because they will get that equipment back that will be worth $5,000. It's not a payment made by Vaden, but it is the return of or the receipt of an asset. So the 5% interest, of course, is different for Connor in this example than it was for Vaden because the receivable is recorded at a different amount than the liability. And then on January 1, 2021, we will debit cash, credit lease receivable, and interest receivable, so on and so forth. And similarly to the previous example, no amortization expense for the lessor because they don't have the asset on their books. The asset is on the books of the lessee, Vaden. 12/31/2021, we'll record the next year's interest. January 1, we'll record the receipt of the payment. 12/31/22, the last year's interest will be recorded, and then on January 1, the last payment will be recorded. Then 12/31, the end of the lease term, we will take that piece of equipment back from Vaden. But now, in contrast to the previous scenario wherein there was no value associated with it, there is value associated with it, so we will need to record that. So we will debit inventory for its value of $5,000. We will credit interest revenue for the interest associated with that amount, and then credit lease receivable for the final balance in our lease receivable account. And then we're through. And then it's just a matter of determining what we do with that piece of equipment that we now have back in our inventory at the value of $5,000.